things like, okay, so there's liability insurance, there's umbrella policies, there's coinsurance, replacement value, things like depreciated value, all these different types of things, terminology that if you haven't heard before, number one, it's overwhelming. Number two, you're not sure what it is. Number three, am I getting scammed by some insurance guy? I don't know.
Getting scammed out or ending up underinsured, which is a rough spot to be in.
Yeah, can you kind of explain some of that stuff?
You hit on a lot of big topics that have large impacts, and from someone who doesn't live it and breathe it daily, might think we're getting the same, but you can have a lot of variation with all those things. You mentioned that all have a different way and they play on the premium. So if you think about from the liability standpoint, that's obviously going to cover if someone alleges bodily injury, property damage, slip and falls at one of your locations and you were negligent somehow, typically we would put a policy together that would have a minimum $1 million of coverage to the entity purchasing the policy. So outside of that, you're going to move into some of the property coverages where you hit on replacement costs. That's going to be the main driver of the premium. And that's going to take into account the way the replacement cost value is created is it's replacing like-kind materials given the age, type of, like I said, type of materials, frame, masonry, combination of both, asphalt roof, 1 story, 2 stories, all of those things that once you say, hey, here's the address, that's up to us to come up with a value of a replacement value to put on the policy that, again, I'm the worst case doom and gloom guy, it burns to the ground or it gets blown up by a tornado, what value could replace that? So, similar square footage, number of stories, the way it is now. Right. Not, well, if something happens to it, I'm going to do something completely different. Right. You can do that, but it's a different way to value and put the policy together.
So here's a question, and I feel like, especially when it comes to investment real estate, maybe it comes up is, okay, the replacement, I bought this property for $10 million, okay? But your replacement value is like 20, okay? I don't want to spend that extra money for the extra 10. I just want the $10 million. Like, how does that work? Can you do that? Like,
yeah.
I mean, those are questions that
So you see that a lot on the personal line side. So if we take and scale it back, you buy a home for $250,000, but again, your insurance replacement cost is $330,000.
Right.
So similar things on the commercial, just, if we're adding or removing zeros, it has some inflated or some additional factors in there, debris removal, site preparation, that inflate not just what you could go sell it for, but again, it's in a pile of rubble from a fire or it's gone altogether, you have some increased costs other than just, all right, let's get the builders in there and go. So
not just green grass.
That example of maybe you got a deal on it, some nuance factors of if you're only looking at covering your banking, commitment.
Yeah.
So say that's 10 million, but we're telling you the replacement value is 20 and you only insure it for 10. Now you're getting into one of the other things that's come up on the policy that we get a lot of conversation about is coinsurance. So all policies have a variation of it. It can be 80, it can be 90, it can be 100% agreed value. And what's that stating to the insurance company is that you're insuring that building within that percentage of what the total replacement cost is.
Okay.
So $1 million building, that's what I tell you the replacement cost value is.
Sure.
Right.
We have a policy written on 90% coinsurance. The most minimum amount of coverage you can put on that policy would be $900,000 to not have a penalty.
Yeah.
So we take it a step further. My note with the bank's only $500,000.
Yeah.
Right.
I only want $500,000. I'm telling you, you agree. If we had to rebuild it, it's $1 million.
Sure.
You're on the policy, you only have $500,000.
Right.
We didn't meet the 90% coinsurance requirement on the policy. So now you have a penalty. Okay. So say you have just something happen to the roof. It's $175,000. Fix the roof.
Yeah.
First thing they're going to say, well, do we have the right value? We should have had $1 million or at a minimum 900,000.
Right.
Insured on the policy, we only have 500. So now you take that loss and there's a calculation.
Apply the same percentage.
Same percentage of what you did insure it for, 500,000. You should have insured it for 900,000. 500 divided by 900 times the amount of the loss. Right. That's the amount you're going to get on a partial.
So on a $75,000 roof that goes to zero, you would only get like 32.5 or something like that, or
correct.
37.5.
You would get that coinsurance penalty for the time of the loss. So that's the number one conversation because it's common. I only want to cover insurance on my bank. That's all that's what required. The first conversation we have, because again, I'm thinking total loss if it goes to the ground, that's how we have to insure it, even though your most probable type of loss
It's a partial.
is a partial. If something happened in the one unit, you have a small kitchen fire, you got 40, 50,000 coverage. Roof, worst case, whole roof blows off, 50 to 100,000 in there.
Yeah.
But the understanding is, I have insurance, I'm covered for anything.
Partial.
Partial,
That's
so it's
yeah.
walking through all those intricacies of
Is
the
there,
policy.
is there ever a scenario that you would tell people that, okay, that might be the right thing for you to do? Or are you always gonna be like, dude, this is probably not a good idea?
There are select circumstances that it would allow,
And this is generalization too, for sure.
that you have to be in full understanding. Typically when you get into not even when you get into high deductible, because you're still gonna have that partial loss. The depreciated thing is still a way to do it. You just have to understand how it works. So say we're good on the coinsurance, but now instead of a replacement basis, we're insuring it on an actual cash value basis. Same scenario.
So you're saying there's two different ways to insure it, replacement and then depreciation basis.
Correct. Those would be the two options when it comes to valuation of the property itself. You can insure on a replacement basis or an actual cash value basis.
Okay, so explain depreciation value or depreciation basis and how that works. I
Yeah,
think you
so
were.
same $1 million building that we're saying is the replacement cost value. One of the biggest reasons why we don't recommend it is because you asked me, so we're gonna put on depreciated basis. How much are you gonna give me at the time of the loss?
Depends.
I have no idea.
Yeah.
On replacement cost, I can tell you.
Yeah.
Because we're agreeing it to it, we're putting it on the policy. We can use ballpark terms, 55 to 65% of that replacement cost value is what you would be given on a depreciated valuation.
There's the depreciation, I'm sure you've got in the insurance industry your own numbers, but is it similar to tax depreciation on the schedule of, or is it?
I'm not familiar with the schedule and how the percentage goes, but it takes into, a 5-year-old building is going to have a different depreciated calculation than a 30-year-old.
Okay,
So the roof is only 5 years old.
Sure.
That's going to be towards that higher 70, 75%.
Right.
More so than a 30-year-old roof, you're going to get
you've got
the lowest
limited
end
life
of that.
expectancy left
Yeah.
out of that, yeah.
So that claim scenario we talked through on the replacement cost, $1 million building, you insured it on an actual cash value basis and not replacement cost, you have a $100,000 loss on the roof. You're gonna have your deductible,
Yeah.
regardless of replacement cost or actual cash value. Then you're gonna take so $75,000 loss minus depreciation, subject to your deductible. That's how much the insurance company would provide at a time of a loss on a depreciated basis.
Not a fun place to be for a risk-averse entity like ours.
And to take it one step further, so that example is gonna cost you, if you have a claim, for conversation purposes, cost you $40,000. The cost of insurance to insure it at a higher value on replacement cost versus that lower value on actual cash value
Right.
is not $40,000.
Gotcha.
It's gonna be more, because you're providing more coverage, but it's not $40,000. It's not like you're
Sure.
saving $40,000 a year
Sure.
to get that lower coverage. It might be $4,000,
Yeah.
$3,000.
Yeah.
Now, actual cash value, that's just, explain that.
That's the
just-
depreciation. In our world, we don't put depreciation on the policy, we put the valuation, not replacement cost, it would be on actual cash value, which essentially is replacement cost minus depreciation.
Would I be correct to say it's as actual cash value at the time of the loss?
100%.
That's the key there.
At the time of the loss,
Yeah.
not when because it's nowhere in the policy because you can't determine it.
Right.
If you write the policy and you have it for 10 years,
the loss
you're gonna have way more depreciation.
Right.
Or you might have put a new roof on.
Sure.
So it's very
Okay, so like.
variable.
Say you put a $35,000 roof on one building, okay? And we have it on for 10 years, and then all of a sudden,
Have a loss.
we have a hailstorm, and that's somehow is the only building to get screwed up, okay? What are you gonna do to figure out the actual cash value? It's no longer 35, that was a replacement value, right? And so now you've got the 10 years to depreciate the roof off, which let's say it's like 50%, assuming it's straight line is 20-year roof.
Sure.
So what, they're gonna give you basically half of that, is what you're saying, roughly, ballparking?
My answer would be, let's write it on replacement costs. I'll tell you exactly what they're going to do. Depreciated, this is the great conversation because this is how it happens. I don't know.
I have no idea.
We can use that 50
Assuming-
to 70%
Yeah,
number.
assuming that straight line depreciation, I think that, for
And
the
trust me,
example,
the-
makes some sense, but. yeah.
When we get into actual claims of, we can sit here and talk what ifs, it would be close, but at that time, if you have a loss, whether it's replacement costs or actual cash value, the adjuster will get involved, and there's specific calculations, which I think you hit on before. It's not as
Perfectly straight
regimented
line,
as a
yeah.
tax depreciation schedule, but
Yeah.
there's all those factors that go into that would come up with. It's not just the insurance company's going, 40. There'll be a calculation that you would see at that time, but again, the frustrating part is let's do it actual cash value. Okay, there's the conversation because it can't.
So
it's all what ifs.
you're saying replacement superior because you're eliminating a lot of variable
You're
risk.
paying to go replace it, subject to your $1,000, $5,000, $10,000 deductible. Cost you 35 grand. Insurance company's going to give you that minus your deductible.
So, yeah. So from a risk mitigation standpoint, replacement's superior because you no longer have a variable, right? We don't have to worry about, we need extra large cash reserves for a what if happens.
Your budget would be your deductible amount of, if you have one roof loss, all right, 5,000. If we have two, for whatever reason, 10,
So from a capital efficiency perspective as well, since we capitalize the way we invest, we capitalize each entity very well, these very large cash reserves. We don't have to increase our cash reserves, which means inefficient working capital, right? We're not just having
sitting
dead
there.
money. And so it's actually, from an investment perspective, very efficient to buy replacement versus this depreciated basis, even though we could potentially get a marginally lower premium, right?
And that's, I think, the rub, and you hit on that earlier, that the savings are, I don't want to say nominal, but not significant enough to justify.
You want to sit there and
capital
sign
you have to
something
sit on.
saying you're going to guarantee you don't have a loss for 20 years?
Right,
You could probably get your savings back
sure.
by doing it that way.
Long, long time and unknowns.
But I don't
Yeah.
think, knowing what I know of how you operate, that doesn't usually fit.
It's not gonna,
I mean,
not gonna work.
it's
Yeah.
not going to work for anybody who's serious to try to make a real investment that's actually going to make a meaningful difference in
Isn't
their
going to
life.
save a pennies to make
No.
there's other things we can discuss from a premium perspective. It's not on replacement cost versus actual cash value.